Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. I hope you all had a good weekend. I am still recovering. My son had a birthday party for his 12th birthday, and my wife was a brave soul and okayed 13 of his buddies to have a sleepover at our house. And oh my, 13 12-year-old boys. As I told one of the kids' dads who texted me while the party was going on to see how we were making out, I told him now I know what it was like living during the time of cavemen. I mean, they are just full of energy. I mean, off the charts. So we took them to dinner. We took them to a movie, and my wife, she's smart. When we got to the restaurant, she made sure to go around and apologize to all the diners, anyone within sitting distance of us. We apologize. We know you wanted a quiet meal. We're going to do our very best to contain the boys and keep them quiet. And for the most part, they were. And then we went to the movie, and they were captivated by the movie. They stayed quiet. It was great. And then we got back to the house. It was a little bit late. It was probably about 11 o'clock. And my wife said, "You're in charge of policing them." She said, "You stay in the family room, sleep on the couch, so you'll be able to hear them in the basement. And you go down around midnight, tell them to go to bed. And they give them the curfew." And I said, "Okay, great." So around 12 o'clock, I went down. Boys were in the basement playing, and I looked under control, and I said, "Boys, time to lights out. Going to give you a 10-minute warning." And they said, "Okay, no problem, Mr. Alkin. We're good." I said, "Great." So job accomplished. So I thought I heard some moving around about 1 o'clock. I went down, and lights were on. There was absolutely no way that these boys were sleeping. They were running around like crazy. So I gave them, "Guys, time to go to bed." Now, many of these kids had a playoff basketball game at 1:30 on Saturday, so they needed their sleep, my son included. So thought I had it under control. I shut the lights off, went upstairs, went down at 1:30. My voice wasn't being heard. They were still up. I went down at 2, still up. Somewhere along the way, about 2:30, I must have fallen asleep, out like a light on the couch upstairs in our family room. Next thing I know, I wake up. I feel someone staring at me. It's 8 a.m. in the morning. I look, and there's my wife standing over me, staring at me. Apparently, I'm not a very good security guard. It turns out at about 4:30 in the morning, the house alarm went off. And my house is pretty fortified. And I have a house alarm that you could hear for a long way. It goes right to the police station. I slept right through it. The entire house was up. My wife was downstairs. And here I am sleeping like a baby. My daughter was downstairs when the alarm went off. Apparently, the kids had also clogged up the toilet. My wife was plunging the toilet at 5 a.m. I didn't hear a thing. So my house alarm goes off. My toilet is a mess. I'm sleeping like a baby. And I am told, from what my wife tells me, I am no longer in charge of future birthday party oversight. Now, I got to tell you, that might not be such a bad thing. But that's how my weekend started. So hope you had a better weekend. No, but really we had a lot of fun, and it was great. Anyway, on to the stock stuff. Last week was a wild ride. The S&P dropped about 2%. The tech-heavy NASDAQ, it did a little bit better. It lost a little over 1%, but the Dow got hammered. It was down about 3%. And it was an odd week because it started off relatively positive. The S&P jumped, I think, a little over 1% on Monday. But somewhere midday or so on Tuesday, when new Fed Chairman Jerome Powell testified before the House Financial Services Committee, stocks got hammered. And I always like to say, don't confuse a good economy with rising stock prices, because if the economy is too good, the Fed could raise rates to combat inflation, which you get with a strong economy, and those rate increases could hurt earnings. I think something like now it's about 40% of debt issued by Russell 2000 companies is floating and tied to LIBOR. and susceptible to a rise in the benchmark rate. And during the Q&A session when Powell was speaking, he noted that his economic projections, they've increased since the December Federal Open Market Committee meeting. That's where all the Fed governors get together. And that scared Wall Street due to their concern that the Fed may hike rates more than the 3 that were expected. And, I think the CME Fed Watch tool that places a chance of a 4th rate hike up about 32% now versus it was 24% the week before. And the chances of a March rate hike are at 83%. So the markets don't like uncertainty, and that scared the markets. And then you fast forward to Thursday, and the equity market was really dealt a blow. And this time it came from President Trump, who announced that he's going to be imposing tariffs on steel and aluminum imports, 25% for steel and 10% for aluminum. And that decision prompted concerns about higher prices, inflation that the consumer will foot the bill for, and retaliation from China and other major trading partners. So I'm going to discuss the trade wars in more depth, the potential trade wars that can come from these tariffs in the educational segment. But so the week, I think during the week last week, 11 of 11 S&P sectors finished negative. So they all did. Industrials were down 3%, materials down 4%. Tech held up okay. It was down a little bit less than 1%. The consumer staples segment was down about 1.3, 1.4%. So it was a sea of red last week. And if you've been listening to me on the podcast, or if you're a subscriber to my newsletter, you know that I think the stocks are in very tricky territory right now. And I've gone, for my subscribers, I've gone in depth about concerns, and I'm really urging people to really examine what they own and why they own it, and to be disciplined in their investing program. One of the things, I think we're 9 years in now to a bull market, and that's led to increased risk taking. And I think now's the time to be thinking more cautiously. And in today's interview, I'm bringing on a guest who's made his living with a balanced approach to investing. He manages a combined fixed income and equity portfolio, and I've known him for years, and he does it exceptionally well. And he and his partners manage their clients' money with a goal of capital preservation first and foremost. Now, you're going to hear he's a bit more bullish than I am, but I think that's good. I think it's here to hear different views other than just mine. Now, I will tell you this, the podcast is new, relatively new. This is our 4th episode. And Alex came in studio this time. And I'm learning on the fly on certain things about podcasting. And one of the things I didn't realize is that if you share a microphone, the sound quality can be different, which my sound engineers down in Maryland told me when we were doing this. So we had one microphone, and we were both standing right near it, sitting right near it. So the sound quality might sound a little bit different. I might sound a little bit further away. But I just wanted to give you that heads up. So I think you're going to really enjoy listening to Alex. Let's bring him on. Alex Oxenham, partner and co-portfolio manager of Hilton Capital Management. Welcome, Alex.
Mike, thanks for having me. It's a pleasure to be here.
You bet. So we are talking stocks over a beer. Alex Oxenham and I have known each other almost 10 years. He is what I think of all the guys I've met over my career, one of the most thoughtful analysts, portfolio managers that I've ever met. And I have talked stocks and macro with him at length, ad nauseum, for a long time. And I'm always really impressed with the different view he brings to things. He's very anti-consensus, but not as a matter of course. But when you talk to him, he peels the onion back to layers you might not have thought, or things you might not have thought about. So Alex is a portfolio manager at Hilton Capital Management, which is based in Long Island, New York. The firm was founded in 2001, and they manage about $1.4 billion in assets. And they're really a balanced portfolio manager, right, Alex?
Yeah, effectively. We get put in a lot of different buckets, but that's probably a pretty good one.
So they manage private accounts, and they also have a 4-star rated mutual fund. And what's the name of that fund?
Yeah, our fund is the Hilton Tactical Income Fund.
Hilton Tactical. So what does a balanced fund manager do?
So, I mean, traditionally, a balanced fund manager is someone who would, invest half the portfolio in stocks and half the portfolio in bonds. But back in 2001, we were founded by Bill Garvey, and he had kind of a different principle to that. He was running fixed income money for a large group of private clients, and he got the idea of, hey, I think your bond portfolios are great, but if I added in a mix of traditional yield investments other than fixed income, things like perhaps MLPs, REITs, preferred stocks, and a little bit more esoteric fixed income, he said, I think I can not only get you a better yield, but give you a better attractive total return and do it in a way that doesn't meaningfully add the level of risk that you're taking. And that's kind of the firm was founded.
So would you say, what's your number one priority? Is it capital preservation? Is it yield? How do you think about that?
Yeah, it's definitely not yield. If you focus on just yield, you're likely to blow up. And I say that kind of half jokingly because there's a lot of ways you could construct a portfolio today to have a 6 or 7% yield, but I don't think it's a real sustainable portfolio. You could create a portfolio with a low yield, and a lot of these other balanced funds in the marketplace have that. But what we really try to do is participate in the markets with a focus on generating income for you, but at the same time trying to deliver a competitive total return over a market cycle. So being hyper-focused on avoiding large drawdowns. I mean, I think that and this is my belief as well as our firm's belief, is that real money is made by letting your money compound, right? It's not trading in and out. It's letting your growth grow and then continually to grow it. And one of the worst things you can do for compounding wealth is to have a large drawdown, right? The law of numbers.
Exactly.
And if you lose 50%, you got to make 100. So if you don't have to chase every penny in every bull market, but if you can, in the bear markets, maybe capture, 40, 30, or only 20% of the downside, there's a lot less work you have to do on the other side.
Now, so you mentioned Bill Garvey, who I know Bill well, and he's a fabulous money manager, and you guys have really done just a terrific job. And Craig, who's with you.
Yeah, Craig O'Neill and Tim Riley, someone who just joined on our portfolio management team. The firm's been growing. I mean, I joined almost 7 years ago, and we were $350 million under management, and we've been growing ever since as the story kind of gets out and it resonates well. And
I've had the luxury of seeing the process, how you guys manage the process. 2009, interest rates are, let's say, zero effectively.
Yeah,
right?
Fair enough.
Fair enough, right?
Splitting hairs.
Yeah, exactly. So you're running a yield portfolio, right? And now here we are 9 years into a bull market, and rates are starting to go up. Walk listeners through the evolution of how the portfolio has evolved during that time and what you are looking at to decide what percentage of the portfolio is fixed income, what percentage is equities, and how you're thinking about it. How does a balance manager think about that? Because a lot of our listeners will have a balance, right? And one of the things I've been talking about is what I call yield tourism, which as rates have been down, they go and reach for maybe yield in things that might be outside their comfort zone.
Yeah.
How do you think about that? How do you maintain your discipline and kind of walk us through the evolution of the last 9 years?
Yeah, that's a lot. And this is, I think, probably going to be the most important part of the podcast. One of the things that I think the reason we've been successful and why I feel that Hilton does a great job is not only do we understand what's happening in equity markets, but we understand what's happening in interest rates and fixed income markets as well. And I think a lot of the knowledge that's going on in the rates world, or say currencies or commodities and the equity market, they're sympathetic to each other. And I always wonder how these managers that just run growth stocks, run a growth stock portfolio and don't have a position on the U.S. dollar or a point of reference on interest rates. A lot of them are kind of clueless, and I always struggle with that. And so what we've done at Hilton is we really every day, and it's like the ethos of the firm is to focus on the big picture, right? What's happening in the world today that could change, that would have a meaningful impact? And so this top-down global macro view that all the marketing people would talk about.
So that's how you start. You come at it
every morning. Like, it's not like it's part of our process, but that's what I do. I mean, I go on the Bloomberg every morning. I look at interest rates, commodities, economic data, and mergers and acquisitions. And that's just what I look at.
And for listeners who don't know, when you say rates, you're looking at the 10-year. You're looking at corporate bonds. You're looking at all different bonds.
Yeah. So when I look at rates, like what matters is when it comes to rates, I look at that whole term structure of the U.S. So anything from 2s, 3s, 5s, 10-year and 30-year rates. I look at LIBOR. And then I look at usually gilt or Bund rates, so British or German rates as well. Not necessarily the foreign rates every day, but certainly the U.S. rates every morning, just to get kind of an idea. And I keep an eye on them during the course of the day. If there's a Fed announcement, what's the movement like? If there's something else. It's just very important to understand what's happening in the rates market as well as what's happening in the equities market.
And explain why it's important.
Because as you kind of talked about, right, we've had low rates for, 9 years now. The equity market's benefited from a tremendous amount of debt issuance by corporations. And that debt issuance is interest expense. So the lack of a high rate of interest is improving the corporate earnings of corporations. And as interest rates rise, that debt expense theoretically grows for the market.
And we've seen companies borrow money, take on debt to buy back stock, which has helped earnings as well.
Absolutely.
Yeah,
absolutely. And it's, that's not necessarily, and we're diverging a little bit, that's not necessarily a bad thing.
Right.
But I mean, and just in the last few weeks, already this year, the average interest rate from a LIBOR perspective is 90 basis points higher. So call it 1%. And
90 basis points being 0.9%.
Yeah. So we'll call it 1%.
Yeah.
And let's say you're a medium-sized REIT, and you have and you're levered up like all REITs are. You have $1 billion of outstanding.
Levered meaning debt.
Yeah, meaning debt at the property level, debt on the corporate level.
Right.
And you have $1 billion of debt. If you pay an extra 1%, that's $10 million of earnings out the window. And a lot of the debt that these companies own or have issued is floating rate. So the rates move up. They have no choice. So you're starting to see that impact companies on on a daily basis. And so it does put the buyback thesis a little bit more at risk broadly. Yeah. Not for, obviously Apple or something, it's irrelevant to them.
And we're going to dive into this further because in a little bit I'm going to ask you how you come up with your view. But let's walk. I think it's interesting for listeners to learn about what your routine is. So talk about that. It's after rates. What do you then look?
Yeah, I look at commodities as well. What's going on there? Then I look at the dollar. Often those rates, the dollar, and commodities are all linked together. It's funny. I can go back and maybe I'm skipping ahead to your questioning. What got me interested in doing this as a profession? And everyone has.
I was going to go there. Yeah.
Yeah, and everybody has, and it's germane to your question. Everyone has a different reason. I can remember 3 distinct moments. One was I was maybe a 10th grader in high school, and I had a friend of mine who was really into computers. Mike knows him. Anyway. And he lived with his dad, and I'd come over, and one day he's looking at the stock pages in the San Diego Union Tribune.
Right.
And I say, "What are you doing?" He's like, "Oh, my dad said if there's like a product that I like, I should look at the stock." And I'm like, "Oh, well, what's that?" And it was Hasbro, and he shows me the stock chart in the newspaper. And I remember going, "Oh, wow, that's pretty neat." And ever since then, I've kind of been curious. I realized that companies have stocks and that it's something I should be interested in, right? Sure. So I kind of followed it. And then as I started going through undergrad, and we were learning about the concepts of corporations, and the professors always referred to corporations as like living, breathing entities, like an individual. And I wasn't a great student or anything, but I was paying attention, I guess, during that lecture. And I'm like, what do you mean? They're not living, breathing. They're like, they make stuff and they sell stuff. And then it slowly started to occur to me that, you know what, they are. They're organisms because of how complex they are, the behaviors that they have, and it all kind of ties down into the stock price.
Right.
And then later in my career, maybe when I had first started, I started to realize how interconnected everything in the world was, and how an interaction in, this is a bad example because a lot of people won't agree, but I kind of believe it, is that the food riots that started in Tunisia, I don't remember when, maybe 10 years ago, there was a lot of food price inflation, and you had riots in Tunisia, and it was associated with lowering interest rates and how that had an impact on pushing up the prices of commodities. And it was like a eureka moment for me that I could really understand how everything is interconnected on what seemingly seems like useless data. And that was like that was it for me.
So that was the beginning of the formation of you having a top-down view.
Correct. Yeah.
So you're paying attention to commodities, you're paying attention to the dollar, you're paying attention to interest rates.
Yeah.
What do you do with that? So I know you and I know how well you invest. You're not reacting to what's going on. You are forming an opinion and anticipating.
Yeah.
I always say Gretzky, skate to where the puck is going. How do you use those to formulate a thesis on where things are going?
Yeah, I can't ice skate, but so I would probably skate to where my face was going to fall into the boards. But no, so it's funny, this global macro thing, it's very hard to get your hands around. And for your listeners, you shouldn't be intimidated about it. But what you should do is you should try to understand it, because you'll find every year you'll get better at kind of understanding it. Mm-hmm. And what you'll realize is after you've been doing this and for 4 or 5 or 6 years, it's not kind of the understanding of the environment that matters. It's the changes at the margin that are occurring that matter.
It's all about the rate of change, right?
Yeah, it's about the rate of change. It's not whether you're in a booming economy or you're in a recession, or you're going into a recession, or you're coming out of a recession. It's not about that. It's about the changes at the margin and how you can position your portfolio to take advantage of that defensively or opportunistically.
I think people a lot of times look at absolutes and not rates of change.
Yeah, exactly.
And compare prior periods and say, well, it's not nearly as bad or as good as then. But the reality is the market's pricing in the growth or lack of growth, and it's moving based on that.
Yeah, I like anecdotes, and I'll give you an example of a good one for this. Is that, and I've also realized this. Maybe I've realized this lately, is that investing is a lot like other things in your lives. Really, any specialty that you do literally can relate anecdotally to top-down macro investing, and fishing is a great example of it. Like, any one data point's not good, right? Everyone knows that you catch more fish at high tide than you do at low tide. And then you catch even more fish when the tide's coming in.
Right.
And then it's not quite as good, but still good when the tide's going out, right? And, whether it's sunny or cloudy out, whether it's windy, what the water temperature is, where the ridges are, if it rained, the turbidity of the water. There's no sort of set time. You need to have a confluence of certain events to decide whether or not you're going to catch a lot of fish or a little. Right. Investing is the exact same way. So whatever it is you do in your professional life, whether it was building houses or mining for copper or a textile business, or you're a professional bass fisherman, investing and understanding those core competencies that you had that made you good, apply that same mindset to investing and just figure out what the principles are that matter.
That's a great point. So interest rates, they're zero, a little bit more than zero 9 years ago. As the market's evolving and how are you shifting the portfolio? And even like right now, right, the economy is looking really good, but that means inflation might be rearing its head. Rates are starting to go up. How do you think about positioning? And I think it's germane because a lot of our clients may have shifted money out of fixed income into equities. And how do you think about it all?
Yeah, it's a good question. I think I can just go kind of into the view. Historically, we look for a lot of different key economic indicators to try to figure out at the margin if we should take more or less risk. And I mean, last year was kind of a perfect example. We had seen the recovery in the data. You could see it in things like, and this goes back to the fishing analogy, consumer confidence, ISM services, and manufacturing data, small business sentiment, leading indicators, credit spreads were declining. And I would add, credit spreads are a great kind of tool that whatever your process is, you definitely need to implement.
Can you explain credit spreads to the listeners?
Yeah, so credit spreads are the worthiness of a borrower. Think about it. You have two friends. You have that really rich friend, right? We all have one of those. And then you have that degenerate friend.
And we all
have probably two of those. Right. So you're having a barbecue at your house and, shrimp on the Barbie. And your rich friend says, Mike, I need to borrow 50 grand. And it's a business relationship. And Mike says, all right, fine. You got to pay me 5%. And your friend agrees. Okay, great.
Right.
The degenerate comes over and, he's like, Mike, I need to borrow 5 grand. And Mike's like, all right, your interest rate's 15%. Right. So Mike's going to charge more for a lower creditworthy borrower than he would for someone that he knows is going to get the money back. That's the credit spread.
Yeah.
So a solid company like Google, let's say, would pay 50 basis points or half a percentage point over treasuries, whereas a company that's less attractive, significantly less attractive, like Newell Rubbermaid, might pay 350 basis points over.
Right.
Now, there are credit spread benchmarks, so you can look at, investment grade credit spreads, and that's really a good one to use. And every day they move. As they tighten, the implied credit worthiness of the borrower is improving because they're lower.
Right.
As spreads widen, the implied credit worthiness of that borrower is deteriorating. So typically, prior to a recession, you see spreads widen. You'll see spreads widen. You'll see unemployment rates increase. You'll see declining consumer confidence, and you'll see declining manufacturing and service economy data. So you can tie all of those things together. But I would think the one that is the most important, for at least from my point of view, and right or wrong, is credit spreads. And so not every increase in credit spreads does it predict a recession, but it's a great tool for someone to use to make these changes in their portfolio. It's one we rely on quite heavily. And
one of the charts in the presentation that Hilton has is just spectacular, and it shows how you guys throughout the downturn took your equity weightings before it cratered way down, and how you've then started moving your equity exposure much higher. I think in 2008, you guys went from nearly a 40% equity weighting in 2003, 04. And by 2008, you were down to 23%. And you took it as high during 2012, 2013 to close to 60% equities. And you're sitting now, I think through the end of December, you were sitting at about 49%. So that's showing, and it goes as low as 23, as high as 60, and now you're about 49. What's driving that decision making?
Yeah, and there's a lot of things here. I mean, some of the things we think it's very difficult to time the market, and we'll always have some measure of equity exposure. We may pull it down dramatically, and in very bullish time periods, we'll always have some fixed income in the portfolio, while it's virtually impossible to time the market. So, but what we saw in 06 and 07 is we saw the equity markets going up pretty consistently, and then we saw credit spreads widening, and not only just in bonds, but in other types of instruments. And those two don't go together. So when stocks perform well, you should see credit spreads narrow, or at least not widen, right? It's very unusual. And so we always have the belief at the firm that the fixed income markets are smarter than the equity markets.
I always say that, and people look at me and say, what do you mean? I say, because the fixed income market knows.
Yeah, they're bigger. They're bigger. And, we could do a whole nother podcast on if that's actually true today or not.
Right. Yeah.
Right. But that's for probably episode 6.
Exactly.
So that kind of happened. And lo and behold, the bond market was right. And we had a pretty severe financial crisis. And we had successfully taken down our equity weighting to sub 30%. So clients were happy. We were happy. Our process worked. And then as the Fed started to intervene, and the ECB and the Bank of Japan, it became apparent to us that they were putting a floor under asset values, and that was a time to start incrementally adding back to risk. So there weren't any key variables for getting back in. It was more subjective, and
it's the art of what you do.
Yeah, and investing. And if you ask any of my partners at the firm, they would tell you that investing is more of an art than a science. So if anyone tells you that it's a science, you should probably, politely
I agree.
Excuse yourself from the table.
Yeah.
So we started adding back to risk, and in Hilton fashion, we don't do things quickly, very methodical, and sort of took our weighting up for the next 6 years to anywhere between 45 and 60% in equities. So today we sit a little bit more aggressive than neutral in the equity portfolio. That's really a reflection of us seeing the economy accelerate in 2017 pretty dramatically. That one was data driven. You could see that occurring.
So that's I want to stop you there. One of the things I say to listeners and I write about in my newsletter is don't confuse an economy with stock prices.
Correct.
So for me, and I'm more cautious than you, from rising rates, I think inflation, I think other things. But can you expand upon your view? Because people often say to me, but Mike, how can the economy be doing well and maybe stock prices potentially not do well, or vice versa?
Yeah. So it's not as simple as the economy. Now we run a quote unquote balanced tactical portfolio. So we're shifting between fixed income and equities. And by and large, if you get the economy right, there's a high correlation to what the stock market's going to do. But Mike's right. It's not necessarily a year-to-year thing, right? Interestingly enough, when interest rates reach kind of a certain threshold, the correlation in equity prices goes negative, meaning as once rates reach a certain threshold, it starts to negatively impact equities. Historically, that threshold has been 5%. And there are a couple firms that have some good slides to that effect.
So here we are with the 10-year approaching 3%, coming off of 1.3, I think it was in 2016. So you would say, okay, well, we're a little bit a ways from the 5%.
Yeah.
But, it's interesting. I look at some of the banks and when they're reporting their earnings, and I see that they're taking their loan loss reserves up for consumer credit across the board.
Yeah.
And when I look at subprime auto, for instance, which is 20% of the loans in the auto land, those defaults are approaching debt crisis, global financial crisis levels. But mainstream credit, good credit, is lower. Is the market focused on the 5%, or is the market focused from here on the rate of change that's occurring year over year? Because it seems the banks are taking up reserves meaningfully. What is the equity and fixed income markets focused on as we're seeing rates start to rise right now?
Yeah, I appreciate that, Mike. That's a good question. So I think the natural level of where interest rates are going to begin to impact stock prices is going to be lower than the 5%. And the reason I think that is going to matter, it's because we've had low rates for 9 years now, and we're increasing off of a lower base. We also have tremendous intervention by the Fed, which is now unwinding the balance sheet, by the way. So that's an important consideration. But the ECB and the Bank of Japan are aggressively buying bonds. One of the things that was a great research report we read and we had a long meeting about is that because rates in Europe are broadly negative. I mean, I think
can you explain that?
Yeah.
Real rates and
so the ECB, as everyone knows, during the financial crisis, the U.S. government, right, we bailed out the automakers. The Fed increased their balance sheet tremendously, bought mortgage-backed securities and other government-issued notes. What they did is they pushed down interest rates, which allowed companies and individuals to borrow to buy cars or companies.
And just to a little bond buying 101, bond prices and yields work inverse to one another. So as there's more buying pressure, it's driving prices of bonds up and interest rates down.
Right. So what that did, and you can, you get on CNBC or wherever you consume your financial news, and that improves asset prices. It worked. The U.S. economy recovered, much less so than it had prior, but that's another podcast. So the ECB followed suit, right? It worked here, it worked there. But they did it at a magnitude, I think, of 4 to 5 times greater than what the Fed did as a percentage of Europe's balance sheet.
And the ECB being the European Central Bank.
Right, which is the European Fed. So they bought so many bonds that they actually took interest rates negative.
Stunning.
It's not a unique phenomenon. It's occurred before, but it doesn't really make a lot of sense. And so, and this gets back to kind of my point today, and this might feed into Mike's thesis a little bit, and he's a little bit more bearish than I am. I'm optimistic. But as a result of negative rates in Europe, the European investors, they're not unintelligent. They're not interested in buying negative yielding debt. So what they've done is they've converted to dollars and they've invested in U.S. credit markets.
Right.
And so I think today credit spreads are, even with the recent kind of volatility we've had in the equity markets, credit spreads have hung in there pretty well. I mean,
has that surprised you?
Yes, it has, actually. A little more than a month ago, we were at cycle lows on spreads. We've increased a little bit here. And I go back like, well, what's the reason for that? And I think the reason for that is there's a lot of buyers in the U.S. credit market that otherwise wouldn't be there. So I think that
are they reaching for something, or are they're
reaching for not negative yields?
Negative yields, right?
Yeah.
Are they less focused on credit quality when they're reaching, or how do they think about that? Do they sacrifice quality for yield?
Absolutely, they do to a certain extent.
Okay.
But this pressure and this downward pressure on U.S. interest rates happens in the AAA bucket as well as the junk bucket.
Right.
Anecdotally, someone was talking to me the other day about foreign investors buying municipal bonds, right? Which they don't even get a tax benefit for it, but because they were highly rated and had a 300 or 400 basis point advantage over an equivalently rated European issue, it was a no-brainer for them. So, and for me to hear that, because I'm not very active in the municipal bond market, is a bit unusual.
Not many people are anymore.
Yeah. So the reach for yield is true. So as I said before, Hilton is very focused on credit spreads, and we're focused on. I think you could see credit spreads higher, even though the economy remains robust. And
what creates that scenario?
The ECB ending the bond buying program and interest rates in Europe starting to increase above zero, I think will end that. And then you'll see an unnatural increase in credit spreads in the U.S. that could potentially put even more rates pressure on the U.S. markets. And I think this year equities they're in a tug of war. I mean, you have on one side a tax cut that's clearly not going to hurt business, right? It's going to be beneficial for consumers and businesses and the economy. And then on the flip side, you have higher borrowing costs. It's like you're an over-leveraged consumer and the credit card just doubles your interest rate, right? Yeah. Think of it that way. And what does that mean for you?
Right.
And on the flip side, the economy is doing great. So you have this tug of war in the markets right now. And as rates move higher and higher, I think the edge will eventually move to rates. And keenly aware that I think the U.S. central bank is aware of that. And I think they'll be more modest in their approach versus what we saw prior to the dot-com recession and prior to the global financial crisis, which was kind of mindless increases in rates.
Why do you think so? Inflation is just now 9 years into dramatic rate cutting with an increase in money supply.
Yeah.
Which more money chasing fewer goods should lead to inflation. But it's been thwarted for all these years. And now we're just starting to see the talk of inflation starting to heat up a little, but heat up is still only 2%. What's been holding it back, and what's your outlook for it? Because I know the Fed is so focused on that. That's one of their mandates, is keep inflation in check.
Yeah, so I'm not in we're going to have rampant inflation camp. I'm wrong all the time, but that's.
I thought I was the only one who was wrong.
Yeah, no. I'm not in the rampant inflation camp. I'm in a moderate inflation camp. The Austrians kind of school of economics is your money supply goes up and you get a corresponding increase.
Right.
and inflation. Well, the velocity of money, right? This is a whole nother concept, has declined precipitously.
Yeah.
So even though you've printed money, it's not really making its way into the system, right? Because
the banks are holding it. Right?
it supported the banks. They, used it as collateral, and but lending's increased. So theoretically, yeah, that's supposed to work, but it really doesn't. I just don't see it in the data, right? So inflation is another data set we look at, and not just broad like CPI or PCE numbers. And PCE came out today; it's at 1.5 year over year, very subdued. By the way, a pretty good environment for equities. But in rent of shelter, which is housing and renting, and in services and goods, those are kind of the three main components. It's not really that high.
They keep out healthcare. They keep out energy. When you pay as an employer, you guys pay healthcare.
Yeah.
You go to the gas tank, you fill up your gas.
Yeah.
All right. I mean, what's your view on that? Because it's really not the real living expenses that we are incurring every day.
Yeah, I agree. This gets into the little Black Hawk helicopter like conspiracy theory.
Right.
Energy, I can see why they keep out, right? Because oil prices aren't going to. They're not stocks. They can't go to $1,000 a barrel. It's not going to happen. So, and it's going to be between 20 and 100 for most of the time, right? So I get keeping that out. Healthcare, a bit of another animal altogether.
So if the threshold rate is 5%, we're approaching 3% right now. So there's some room there, but you think it might come down a little bit. How does that affect you as a portfolio manager in allocating the portfolio between equities and bonds? So you're sitting here in the high 40s now. How do you think about that?
Yeah, so we run a yield strategy, so we're very in tune to the interest rate risk in the market. In fact, we'd pulled our yield down over the last few years and avoided stocks in traditional yield sectors like staples and utilities. We've been overweight financials. They benefit from rising rates. We're going to continue to maintain that course. There's a lot of fluff in some of these sectors.
I'm very bearish on the staples. I'm short the sector, I think, for the most part. I think they've bought back so much stock. They have no revenue growth. They've squeezed out all the margins they can. They've levered up their balance sheets, and they have a whole host of people hiding out there trying to get yield. And at some point, earnings start to come back because they've levered up so much now. It's hard for them to go buy back a lot more stock, and they don't have the growth.
So is that why Cheerios bought dog food?
Yeah,
last week.
That's right. With Blue Buffalo, it's paying $8 billion for dog food, paying 22 times cash flow. Right? You see these things and you say, "Oh my God!" And that's what happens near tops of cycles. You see crazy deals get done.
Yeah, I guess if it doesn't work out, you can say companies are what they eat.
They are. That's right. That's right. But he's talking about General Foods, which makes cereal for them and other stuff. But they went out and spent $8 billion, 20% of their sales on Blue Buffalo dog food, which is good. We use it. But they paid a 22 times cash flow, which is an enormous number to pay. So getting back to thinking about the allocation.
Yeah. So, I mean, for us, and we're the tug of war, right? So on one side, you're going to have the economy pulling things along. And on the flip side, you're going to have rates in a normalizing credit cycle that are going to signal, hey, enough's enough. So I think for us and our plan is to still stay away from the yield sectors. Although I have to say, with the sell-off that you've had in certain subsectors, they're beginning to get a little bit more attractive. Mm-hmm. But I don't think for me, I'm willing to sort of dive into that yet. We're going to continue to reduce our credit exposure, and as government yields get higher, they become more attractive and they're risk-free. So
I was going to say, for somebody who has a portfolio at home, and they're normally a treasury investor, let's say. Yeah. Now they've gone into corporates.
Right, or even junk bonds. For higher yields. And when you're saying reduce credit exposure, what you're saying is as rates come up on treasuries, they're risk-free, U.S. treasuries. Yeah, exactly. Backed by the full faith and credit. So you're going to rotate a little bit into that. Yeah, that's exactly right. That's our plan. So it's funny because anecdotally I had a conversation with a friend of mine who's a retail broker, and he said to me, he's like, I've had a couple inquiries about fixed annuities and CD rates.
When's the last time he had one of those?
And he said he hasn't. It's been about 10 years since people were asking him about it. So, and this gets to my point is that back to when I talked about why I do what I do and why I like it. The economy is a living, breathing organism. Yeah. Companies are living, breathing organisms. the organism is waking up to the fact that there are higher yielding alternatives that take less risk. So at some point, and I'm not sure when that will be, higher interest rates will have an impact on the market. And that's exactly why volatility in 2018 has been higher than expected.
Right.
But I would also add that's a good thing, because we've had muted volatility for 9 years because the Fed has purchased all these bonds, the ECB. They've encouraged risk taking, and people have embraced it, and the economy has benefited.
Do you think there's a financial asset bubble?
I do not.
You do not. Okay.
Yeah, I do not.
So we're on the other side there. So why do you say that? Why do you think we're that financial prices, asset prices are reasonable?
I mean, on a valuation standpoint, equities are 17, 18, 16 times earnings, depending on how you measure it, in the context of a really contained inflationary environment. I mean, we're at 1.5 inflation.
Mm-hmm.
That's not a very high multiple. Now, there's a lot of different stocks in the market, and clearly some stocks are trading at uncomfortable valuations, but broadly speaking, I don't see a bubble in really any sector of the market that's major. I mean, I don't want to get into crypto or anything like that.
Yeah, right.
But housing seems to be fairly priced. There's not a lot of supply. Incomes are up. Job creation is high. Millennials are a huge bulge of the population moving into home buying. Home buying is a building and buying and housing related stocks have a tremendous amount of upside, in our opinion, because of that.
Right.
Not really a bubble. And that's based on affordability is significantly more affordable than it was during the bubble. Right. But in Canada, for instance, their statistics look a lot like ours on the home side prior to us blowing up.
Right.
So are there global bubbles? No doubt about it. I mean, but in the U.S., I think for the most part, things are pretty solid.
How do you think about the deficits when it factors into your calculus? The budget deficits, you're looking at the debt we have as rates go up. How do you think about it?
I think early on in the broadcast, Mike said I was a contrarian, and that I had ideas out of left field that
bring it on. That's what we want to hear.
So we've entered that part of the program. There's been a lot of talk about, and by the way, we're running kind of a fiscal experiment in the U.S. because let's all agree we're near the late cycle expansion of the economy. It could last 6 months. It could last 5 years. I don't pretend to know. I'm going to work hard to figure it out.
Right.
But typically, you're not running a bigger deficit when your economy is running at kind of peak performance. The Trump budget is going to widen the deficit, and they're going to spend money on military, the wall, and whatever else is in the budget. That's very unusual. We've never really done that before. Usually now, when tax receipts are high and the economy's humming along, the deficit narrows.
Right.
That's actually really bullish for stocks, and a lot of people are attributing this rise in rates associated with the U.S. being and putting itself in a potentially future fiscal problem associated with that. I can understand that point of view. I just simply don't agree with it.
What are the touch points that make you disagree with it?
And this frame of reference has changed. So 10 years ago, I would have probably agreed with you that that's a problem.
Right.
But today it's not. When you're the global reserve currency, like the US dollar, liquid, everyone wants it, and you can control the money supply, I don't think that it's highly inflationary I'll be extreme here, for the U.S. to print money to pay off the deficit. I really don't think it is. And I'll frame this another way. So, because you'll see that, and then you'll think, wow, he's a little off his rocker. Like Mike's looking at me a little crazy right now.
We love that. Yeah.
Right. And I'll frame this another way. There was a lot of criticism around it, like the airport product production in Denver. Do you remember this?
Sure. Yeah.
And it was, my numbers are wrong, but let's say it cost $2 billion, and they couldn't afford it, and Denver wasn't growing, and the economy was stagnant. So however they got it done, they built this airport. And I don't know if it was, when did they do that? You travel a lot more than I do.
It had to be close to 20 years.
20 years, yeah. someone did a study that airport has produced $21 billion of economic output since they built it.
Is that right?
Right. And so this gets back to my thinking is, so if you run a deficit and you spend money that you don't have, but it can lead to a huge growth in economic output, I don't think that's necessarily a bad thing. So I kind of treat the U.S. deficit that way as well.
Even in the face of rising interest rates, where we're borrowing and paying higher interest expense on that debt?
Yeah, because the U.S. government can effectively print money to cover it. And look at that's textbook inflation.
Right.
But we've been seeing the ECB do it to the tune of trillions.
Yeah.
The Swiss central bank is printing. They're literally hitting Control V on their laptop and printing money and then buying U.S. stocks.
Buying U.S. stocks. I mean, they're one of the biggest shareholders. It's crazy.
No signs of inflation.
Yeah.
So if these smaller countries can do it, I think the reserve currency could do it as well if it needed to be.
So let's talk about the currency.
Yeah.
I mean, last year, the dollar came off first time in a long time.
Yeah, kind of a surprise, actually.
Yeah. So it has weakened, and it continues to weaken a little bit.
Yeah.
What's your view on the dollar? And if you can explain for listeners the impact, the dollar being the reserve currency, and the impact of the dollar on commodity prices and other things.
Yeah, so commodities are priced in dollars. There's a huge impact in commodity prices linked to the dollar. That's just how it is. Whether you like it or not is irrelevant. Yeah. And the quicker you can understand that, the better off you'll be.
And accept it.
Yeah, and accept it. It's how it is.
Right.
I don't like it,
right,
but that's how it is.
Right.
So, but the funny thing is, and I was kind of wrong about the dollar, admittedly. I thought it would strengthen because we'd have higher rates, better economic growth, a good, the change of administration would be pro-business. So I thought that would be strong for the dollar, and the dollar weakened. So, okay, well, where was I wrong? Well, it was really more a function of other currencies, right? The euro started strengthening, the pound started strengthening. What happens with the dollar, even though it's king dollar and it's the world reserve currency, it doesn't mean it can't be pushed and pulled by other forces. And so I think now the bigger impact is if the ECB and the Bank of Japan slow down their intervention in their bond markets, their currencies will keep the dollar from appreciating dramatically.
Right.
And I think that's kind of what's happening. The ECB, in their most recent press conferences, they're still committed to it, but they're coming to some end date in the future. They're going to reduce the amount. They're going to taper like we are, and that'll probably keep pressure on the dollar.
So if the dollar keeps going down, when we think about the treasuries refinancing their debt, issuing more debt, the Chinese and the Japanese are big buyers of our bonds.
Yeah, that's right. And the citizens in Europe are now as well, because it says a positive yield, pretty good one too.
And so what's the impact of the dollar on their appetite for buying debt?
Yeah, historically it's always been because it's expensive to hedge. So if you're a euro-based insurance company and you're at your board meeting and you can get negative rates in Europe or positive rates in the U.S., you obviously pick the positive U.S. rates, but you have to hedge out the dollar-euro exposure because you don't want to take a currency loss. The yield differential and the expense to hedge are largely close, but obviously beneficial now because the yield differential is so great. So we have a lot of foreign buyers in the U.S. because of that.
Right.
And, I think and I don't know if U.S. rates matter so much. I think it's more the domestic rates to those foreign buyers. That's what matters. And as rates go up, they're not going to want to hedge anymore. They're just going to buy their own paper. So I think you could see this experiment where, and this is just a guess, where the Fed raises rates and rates in the U.S. increase, and they already have, but maybe let's say 50 basis points across the board in a year from now.
0.5%.
0.5%. Yeah. That then the ECB begins to taper and they get positive rates. And then the European owners of U.S. assets sell and then rates tick a little higher than they normally would in the U.S. because of that phenomenon. I think that is something to consider.
So if I was in the corner of the room looking down and just eavesdropping on Hilton meetings 2 years ago, a year ago, and today, I mean, how has the thinking changed, and how are you positioning yourselves?
Yeah, 2 years ago we were relatively negative. We had come from a really bullish position, and we started to see the economic performance of the U.S. decline, right? We had a huge spike in credit spreads associated with the oil price collapse and a lot of the bankruptcies that occurred in the oil patch. It began to impact the U.S. economy. GDP decelerated meaningfully, coupled with a spike in credit spreads. We had pulled back on risk. And then kind of midway through 16 to the back half, you started to see some slight acceleration in the data. 17 remained better. It improved at the margin, but still below potential. And then late, I'd say middle of 17 to beginning of the third quarter, you could really see the data, for whatever reason, inflect higher. And as a result of that, we became much more bullish. But as a firm, we do think we were much closer to a recession in 2016 than people realize. We were close. The spirits had kind of turned. The interest rates had increased for unworthy borrowers, and there was some fearful consternation there.
So if you're 48, 49% equities now,
yeah,
6 months from now we have this conversation. Are you going to be 55? Are you going to be 40? I mean, what do you think about what's going into your mind? What are you, Craig and Bill, thinking about that's going to drive that decision?
Yeah, and when we manage our portfolio, it's funny you say 6 months. We really think about it in terms of 3 months, 6 months, and 18 months, like where we're going. We plan on reducing credit risk. I think I've covered that pretty extensively with you, and as to why.
Yep.
Our equity weighting.
So you're changing the fixed income portfolio. When you have an opportunity to get higher yield from safer fixed income, you do that.
Right. Or even a lower yield, but
that's what I meant.
A lower yield that is still risk adjusted.
I meant a lower
better.
yield. That's what I meant. Lower yield risk. Exactly.
Yeah, that's fine.
Yep.
We'll do that. I think you have this tug of war with equities and the tax cut and the fiscal stimulus and the growth associated with that, and you have the tug of war with rates. Right. It's rates and performance of the U.S. economy. So I don't know who wins that war. I just don't see enough inflation data that would suggest to me that rates will get out of control. So I would probably lean more towards the equity side, and that's kind of how we're positioned. So you won't see us dramatically increase risk from here. In fact, we're going to de-risk the fixed income portfolio.
Right.
And probably hold course
on
for the next side. 3 to 6 months on equities.
Yeah. Well, when I look at your numbers, when I look at Hilton's numbers, and I go back to 2008, and the market was down 37%, and you guys were down 14. And we talked about the law of math before. You think about, and you said if somebody's down 50, you got to double that to get back to break even.
Yeah.
So that was just a tremendous job that you guys did. And what's even more impressive to me is your preservation of capital in 2008 was in 2009. The market was up 26% and you guys were up 23%. And I mean, that's a stunning, not only capital preservation, but you're able to keep it up on the upside. I mean, that was incredibly impressive.
Yeah, thanks. I mean, I think conceptually that, like I said, we try to avoid the drawdowns. Doesn't mean we're going to. We're going to try hard. In the past, we've been fortunate to avoid it. But also the real opportunities to make money are coming out of the recessions. That's when you get really rewarded for risk taking.
Right.
And so if we can capitalize on avoiding the drawdowns as much as possible and then capitalize on the subsequent recoveries, the real money is made in the turn of the cycle, not squeezing out every drop of lemon juice out of orange or the orange juice out of the orange in 2016, 17, and 18. Right. And that's what the financial media and CNBC are all about, right? Markets in turmoil, tax cut. Don't squeeze every drop out of your fruit. Manage your orchard the way that it deserves to be for the long run. And I think it's hard to do because we're emotional animals and, everyone goes to cocktail parties where their friend always made more money than you did. But it kind of block that out and really focus on what matters. And that's compounding wealth over time.
So let's have a free for all here a little bit. I want to pick your brain on things that at times have been in your portfolio, but they're not something you guys specialize on, but you know a lot about. And Bill Garvey is a commodities guy, right, with great experience. So I want to talk oil stocks. And you and I happened to visit the Bakken the day the bell rung, where
it was
at the
October
peak.
13, maybe.
Yeah, 14, I think it was.
Yeah, time's flying by the way.
Alex and I and a couple of other people visited the Bakken, and I tell the story where we paid, I think, $450 a night for a Hampton Inn hotel room. We went to a steakhouse where there were all the roughnecks from the buying $300 bottles of Camus, and two of them.
Only on Thursday when they got paid.
Yeah.
Right.
Buying F-150 pickup trucks, going like crazy. I think the biggest, funniest part of that was when the waitress at the steakhouse told us, well, you should go over to the strip club because all the New York strippers are coming in here because they make more money in Williston, North Dakota than they do in New York City. And we didn't go, but it was pretty interesting.
But we checked around.
Yeah, we sniffed around.
Mike being the analyst that he is, had his ways of confirming that.
Exactly. So we confirmed it. So, but no, you guys were very, very active in master limited partnerships and MLPs for many years. And you've taken down that exposure dramatically. MLPs are very high yielding for those who don't know. I think oil and gas pipelines, and they're very high yielding investments. And you guys had done very well with them and smartly pulled down exposure. How are you thinking about the oil complex now? Oil and gas complex.
Yeah, we actually have the lowest weighting in firm history in MLPs.
Really?
Yeah, we're at about 3%, and we have plans to probably reduce that even further. I mean, I could spend time talking about MLPs, and there's a lot of good research that's available, but the structure of an MLP is flawed. And I don't want to pick on anyone in particular, but investors wanted yield because interest rates are low, and they've wanted yield since the beginning of time. So Wall Street and the oil executives, two groups of people that really love to pay themselves, I think that's pretty fair to say, created a structure where they have a limited partnership that is a toll road. And I don't like that word because it's not true, but that's the marketing spin. And, it pays these dividends and the oil passes through and everybody gets paid. Well, really the people that are getting paid are the general partnership owners of the limited partnership that were getting effectively an override on the income that you were getting. And so their incentive was to grow the income, not grow a sustainable living, breathing business. And so a lot of these imploded when oil prices declined because there were a lot of bad actors in the space. I mean, I can remember back in 2011, there were maybe 5 or 6 different ETFs you could invest in MLPs. And then by 2013, I think there were over 100 funds and vehicles. So it exploded in demand and it imploded on itself. And so working with you helped us reduce that exposure.
Well, you remember when you highlighted to me, they were doing secondaries and it was easy and IPOs were coming out.
Yeah.
And a couple of them failed, right? There were a few that had a hard time pricing.
Yeah.
And to you, that was a great signal.
Yeah. It was a great call for us, but it was actually relatively easy. This was a lot easier than the call that Hilton made in 07 and 08 because you had a confluence of a lot of events. You had massive supply in crude oil in 2013 and 14. So we were 9 to 10 million barrels a day, but yet the price literally increased from $60 a barrel to 80.
Right.
And you're like, all right, higher prices encourage production, more supply impacts with lower prices, right? A cure for high prices is high prices, right? I know it's one of your sayings.
Absolutely. Yep.
I agree.
A cure for low prices is low prices.
Is low prices, right? So, and at the same time in 2013, Bernanke was talking about tapering. So you had an increase in interest rates. You had the dollar strengthening.
Right.
You had investor appetite for MLPs at its crescendo.
Yeah.
Literally everything lined up, right? And then it was, we go out and we see these signals. We've already started to pull down our risk. We go to the Bakken and we realized, I know for me, it was like a seminal moment, how technology was impacting kind of everything. We already knew how it was impacting your phone and ride sharing and how you make your reservations for travel. But sitting in a rig and having a roughneck tell you, 6 months ago they were doing, vertical wells, and now they're doing horizontal and spidering, and the flow rates are triple and double.
Right.
And they can do it 4 times as fast.
And proud to say they could keep producing.
Oh, yeah, at a lower cost. And, it's like you have this eureka moment. Wow, this supply thing is real. And it's funny because I'll fast forward to today, Mike. You've had crude oil goes from 114 to 35 and 16 back to 61. The U.S. is at peak production as of a couple days ago, 10.2 million barrels a day of production. And prices are stubbornly high. Again, peak production. Oil prices are probably going to decline from here.
Well, it's interesting because in that, you want to bring a gas well online, it doesn't take you very long. You want to drill it, it's not long, right? So it's one of the things, my uranium interest, but when production shut down, it could take years to bring it back on. And there's a big difference there.
Yeah, one of the biggest benefits to the MLP thing is funny because I kind of trash them a little bit. And from an investment standpoint, I like to stick by it. But from an infrastructure standpoint, it was very beneficial because we have a very robust infrastructure now in the U.S. to transport a barrel of oil from the Bakken to Philly. Right. It used to be through trains that were blowing up and killing people, right? Which now it's pipelines and gathering pipelines and water disposal pipelines. And in all of the major basins in the U.S., they're relatively well developed, which is funny because now our supply, and with the technology, maybe it used to take a month to turn a well on. Now they can do it in a matter of days. So the producers can respond to price levels quicker than they ever have been before, and they can offload the gas or the oil through an MLP infrastructure more proficiently than they ever have before. So from a U.S. energy infrastructure standpoint, the whole MLP boom was a huge positive for the U.S.
Right.
Yeah.
I want to go off topic of oil and gas. I know that you and I haven't talked about this in a while. Preferreds. I know you were doing a lot of investing in preferred stock. Can you explain them and what your view on them now is?
So in the capital structure of a company, this gets kind of boring. You have a priority of payments. Who deserves to get what, right? So the most senior kind of position you can have in a company from an investment standpoint is we call it a bank loan, right? If the company goes bankrupt, it gets paid back first,
right? And
then you have, secured notes, senior unsecured, common stock. Yeah. So common stock gets all the profits of the company that are left over, but in the event of a bankruptcy, they're the last one to get paid back. Right. So
they take a lot more risk.
But you have all the upside.
Exactly.
A bondholder of Amazon. I mean, what would you rather be? An equity holder of Amazon or a bondholder?
Yeah, absolutely an equity.
Bondholders are getting nothing.
Yep.
So that's why you own stocks. But in between stocks and bonds is another layer called preferred equity. And the preferred name means you get a preferred income stream. So you own equity in the company, but you don't get benefits of the profits, but you get a preferred income stream before the shareholders get a dividend. Okay. So it's kind of quasi-fixed income and quasi-equity.
And you had been a buyer of those. I know my memory serves, a couple of years ago, you were buying quite a bit. What's your view now on them?
Yeah, so they're very interest rate sensitive because we consider them to be more fixed income than equity. We don't really get involved in distressed preferred investing. We prefer, buying anywhere from kind of investment grade to double B plus type credits. Right. I don't want to wake up and have a credit impairment situation with my preferred equity. So in kind of context with how we've been focused from 2013 on about interest rate risk, we've kept a close eye on our preferred exposure. So as far as rate risk goes, higher coupon preferreds have less interest rate risk because they're less sensitive to changes in market rates. Credit spreads are also important, and preferreds trade to a spread as well. So we saw unprecedented tightening in 2017. We had started to reduce our preferred exposure.
Okay.
Yeah, so preferreds have sold off a little bit this year. There are starting to become some single issues that are attractive, but we haven't added.
Okay.
Nor do we plan on imminently adding to our preferred exposure.
How do you handle position sizing depending on where we are, and you're marrying that with your top-down view? Can you talk about what a big position is percentage-wise and what small ones are? How do you think about that?
Yeah, it depends on what the issue is. So again, the whole Hilton tactical income approach is income and risk mitigation, right? So we're different from a lot of other managers. We're not going to take big concentrated swings.
Right.
It just isn't what we're ever going to do. So for us, a big single name position would be 3.5%.
Okay.
And I get for most hedge funds and long onlys that would be kind of low. And they can call me a chicken. That's fine. I accept that role.
Your mandate is to preserve capital.
Yeah. So our smaller position sizes are at 1%. And so we keep it diversified.
So when you're pulling up exposure, you go from 30% to 60%, let's say.
Total exposure.
Total exposure, meaning your 60% equities from 30. It doesn't mean you're taking those position sizes bigger. You're adding more stocks.
Yeah, we're adding more names. Now, we're kind of agnostic to types of securities that we'll use. We'll use anything from a emerging market equity, emerging market debt, to an ETF or a closed-end fund or an individual bond. We're agnostic. So the weightings will shift based on that. So we can have a huge 20% weighting in treasuries, let's say. And we don't, but we wouldn't consider that a concentration. But if we took our equity weighting up from, let's say, 40 to 50,
right,
that would probably be 4 2% names and then add to 2 existing names.
Okay.
Yeah.
One or two favorite sectors or stocks?
Favorite sectors. I mean, we've been, and we remain overweight in industrials and financials. Financials are tricky. It's a bit of a battleground. For us, again, like Hilton we have like an interesting view in the world. It's not how much money you can make. It's how we view things it's how much money you're going to lose if you're wrong. And for us, financials, because as interest rates rise, their profitability improves, and typically the stock prices perform well.
And when you're saying financials, are you talking just banks or insurance companies or across the whole financial complex?
When I refer to it, I mostly mean banks and exchanges. That's kind of good. It's a good question because they benefit from higher rates, and they're a natural offset to the rest of our yield portfolio. So we have a nice overweight there, and we've had that for 1, 2, 3, 4, 5, going on 6 years now.
Okay.
Industrials are benefiting from lower tax rates, accelerated capex depreciation, lower taxes, and a robust U.S. economy. So we've been overweight industrials. So for me, that's it. Those I would stay in those sectors. Yeah.
Sectors to avoid.
Sectors to avoid. Yield chasing sectors. Yeah, I mean there are specific opportunities in REITs. But broadly, I would avoid real estate, broadly would avoid staples, and broadly would avoid utilities.
Okay.
Yeah.
Do you have a view on the auto cycle?
We don't. We tend not to own really deep cyclical companies,
right.
So we don't really pay attention to the aerospace cycle necessarily, or the auto cycle, or really oil and gas outside of our MLPs. Right. Yeah.
So Hilton Tactical Income Fund, it's a 4-star, and you guys just launched that 2 years ago?
So we have 2 fulfillment options at the firm. Most of our business is in separate accounts, but we have a mutual fund, and you should read the prospectus before investing in the fund.
Yeah. And what to qualify for the separate accounts? What does somebody need? How do they do that?
We have a lot of different platform providers and third-party brokers that have access to us.
Could people call you directly and become a client of Hilton?
Yeah, we could do that.
Okay.
Yeah, we have a number on the website. Feel free to call, and someone will reach out to you. So.
And what about the mutual fund? How does that? What different classes?
Yeah, we have 2 share classes, an institutional share class and an A share class. The fund follows the same strategy that the separate accounts do. There may be slight variations in performance, but it's the same structure, and that's up on all the major retail platforms: TD, Schwab, Pershing, Fidelity, a lot of the wirehouses, and the symbols are HCYIX and HCYAX, and you can go Google the Hilton Tactical Income Fund and go to the website and review the prospectus and the tear sheets on that as well. The fees are expense ratio rather is 98 basis points on the institutional share
So if you
class.
have your money in there, it's
less than 1%.
Yeah.
And I think the minimums are $50,000 for the institutional class and $2,500 for an IRA.
Great. Well, I can't thank you enough. It was great. Will you come back?
Absolutely. It's fun. I'm glad. I think are we episode 4?
Well, yeah, episode 4.
It's not bad.
Not bad.
Who says the sequels aren't better than the original?
And we finished a whole beer while we were talking.
We did.
That's
great. Hopefully we'll have another one.
We will. Thanks, man.
Thanks, Mike.
All right, buddy. And now for the educational segment. I mentioned earlier in the podcast how the markets took it on the chin on Thursday when President Trump surprised the global markets. There's a real shock by announcing his intention to introduce a 25% tariff on imported steel and a 10% tariff on imported aluminum into the U.S. Those industries are being hurt by cheaper steel and aluminum being sold into the U.S. while they, when they're selling their goods abroad, pay duties on those exports. Now, as you would expect, Democrats and trade unions loved the announcement, but it also sent shivers up the spine of politicians in President Trump's own Republican Party because they worry about the dire political and economic consequences. Now, this move by Trump shouldn't be a surprise to his own party, though, because during his campaign, populist and protectionist positions were front and center. He talked about it all the time. Yet they make the announcement on Thursday, the White House, and the markets got rattled. So neither his own political party or the market should be surprised, but they were. The equity markets got hammered. The U.S. dollar took it on the chin. And it's all about fears of trade wars that are emerging. And I want to talk about that. Trade wars. Many of our trading partners did not like that announcement coming out of the White House. China, Japan, South Korea, Brazil, Canada. I mean, they were upset. And they said they're going to retaliate by slapping higher tariffs on our goods. And I think it's important. What I want to talk about is the importance of helping you understand the economic significance of tariffs and how they impact economies. Now, obviously, for U.S. steel and aluminum industry insiders, they're jumping up and down with joy for these tariffs as they've been competing against cheap imports of both aluminum and steel. So in theory, you could argue tariffs are a good thing as they protect domestic industries. But in practice, history suggests just the opposite. History shows that what it really does is enrich a small segment at the expense of the broader economy. So as is often the case with these protectionist-like tariffs, the prices for the goods using what's protected, think of what steel and aluminum go into appliances and cars and a host of things, those prices of those goods rise, inflation, for the entire economy, while the benefit falls to those who directly tie to it, those in the steel and aluminum industries. So only those in the preferred industries, those with their goods protected, benefit from the tariffs, right? They see their profit margins are kept intact or they go higher. But the costs, the retaliatory tariffs from foreign governments or lack of access to cheaper substitute goods, they're shared by all of us, the consumer. So, for instance, if the government slaps a tariff on import steel, the U.S. steel industry notices the benefit right away, while the rest of the country is paying more for their goods with steel and aluminum in those processes, right? So we are feeling that inflation. Appliances, cars, buildings, they're all going to go up. So here, the markets earlier in the week, last week on Tuesday, were fearful of rising interest rates because Chairman Powell had suggested they wanted to keep a lid on inflation, even though it for right now is modest, but they want to get ahead of it. Here, 2 days later, on Thursday, tariffs get discussed. And what does that lead to? That's going to basically lead to rising prices. And think of it this way. It's basically a tax increase on the U.S. consumer. So the U.S. consumer was just told that he or she got a tax cut with new tax plan, with Trump's new tax plan. Yet the unintended consequence of these tariffs will be rising prices. taking away the benefit. We don't know exactly how much because we don't know the details yet of the plan of the tariffs, but it can offset to some degree that tax cut. So it's bad policy on its own, but it gets much worse when unprotected industries then go to Congress for similar favor. And, from Trump's perspective, I mean, it could erode his base in rural America and the blue collar workers that Trump says he's trying to help. So there's always retaliation, and typically a lot of these countries who retaliate are major trading partners. They tend to single out agriculture when they do that. So that's not good for the American farmer. Now let me give you some history on this to support what I'm saying. If we go back to 1930, there was the Smoot-Hawley Act, which was a precursor to World War II. Now, back then under Hoover, America embraced a protectionist policy. They levied taxes of up to 50% on imported goods. As history looking back on it, it was considered to be a huge mistake. It crippled global economic activity, and it helped accelerate the decline in the Great Depression. And the global trade freeze only ended when Congress passed the Reciprocal Trade Act of 1934, which gave FDR, who was then president, the power to negotiate these bilateral trade deals with other countries without congressional approval. But by that time, the global economy was already broken, and it gave rise to all the nationalist populism in Europe, and that brought on World War II. If we look for a more recent example, George W. Bush in 2002 initiated a steel tariff. And I think that's a useful guide as to where we are today. And because then by 2002, the EU was in existence, China was already in the World Trade Organization. And at that time, President Bush slapped tariffs on steel coming into the country, which ranged from 8% to 30%. And if you go back and look at some of the studies on what the net negative consequences for the U.S. economy were, they were pretty staggering. 200,000 Americans lost their jobs to higher steel prices in 2002. Those jobs represented about $4 billion in lost wages from February to November 2002. So more American workers lost their jobs in 2002 due to higher steel prices than the total number employed by the U.S. steel industry itself, which was about 187,000 people in December of 2002. 1 out of 4, so 50,000 of these job losses occurred in the metal manufacturing, machinery, equipment, and transportation equipment parts sectors. Every U.S. state experienced employment losses from higher steel costs. The analysis shows that American steel consumers have borne heavy costs from higher steel prices caused by shortages, tariffs, and trade remedy duties, among a host of other factors. The U.S. dollar during that time got slammed. The stock market doesn't like uncertainty. We saw that Tuesday when we thought we were going from 3 hikes to possibly now 4. Stock prices started to sell off. Uncertainty was added to the mix with these tariffs. We'll learn more this week about the details of those tariffs. But the possibility of trade wars emerging from them add a whole level of uncertainty to the market. And 9 years into this bull market, I think one needs to really be cautious in how they're positioning their portfolio because the uncertainty at this point in the bull market cycle can lead to stock prices in for a rough road ahead. Anyway, that's the podcast for today. I hope you enjoyed listening, and I look forward to speaking with you next week. I will be speaking to you from a remote location, and I'll fill you in on the details when we speak. Have a good week. Thank you.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.